Hello, everyone, and welcome to another episode of Selling Greenville, your favorite real estate podcast here in Greenville, South Carolina. I'm your host, as always, Stan McCune, realtor right here in Greenville, and you can find all of my contact information in the show notes if you need to reach out to me for any of your real estate needs. And please, if you enjoy this content, just hit a little subscribe button, hit a little like button, you want to leave a comment, any of those good things that helps to support the show and just helps me to realize that there's people actually out there watching and listening. If you leave a comment, by the way, I'll try to respond to it. So I'd appreciate if you guys could do all of those things and use me as your realtor. That's the only other thing. That's why my contact is in the show notes. So please do that if you don't mind. Today, we've got a different kind of episode. This is not going to be a Greenville specific episode, but we've talked a lot over the years about real estate investing. Obviously, there's been a lot of money over the years that has flown into the Greenville, Spartanburg, Anderson market. Now, even Lawrence and Pickens counties are starting to see it as well. Investor money in this area. We've talked a lot about investing in real estate over the years. And so today, I have the privilege of interviewing Ben Stef, who is a loan officer with Funding Freedom. And he, one thing that I really try to do when I'm interviewing people is I usually won't have people on this show unless I have worked with them in some capacity in the past. Because otherwise, I might be giving you a lousy recommendation. Ben is someone that I have worked with. I recently closed on a home equity line of credit on an Airbnb property, so not an owner-occupied property, something I'd been turned down by other lenders many, many times for. And so, and actually, Ben reached out to me originally to come on the show, and I was like, well, I gave the disclaimer that I'll do that with people that I've not worked with, and then I ended up working with him, so now he gets to come on the show. So anyway, well, all that said, Ben, welcome to the show.
Hey, thank you for having me, Stan. Appreciate it.
Absolutely. So, the loan product that I got was a home equity line of credit on a rental property, an Airbnb specifically. It was a DSCR style loan. If you don't know what that is, look it up. I don't have time. Maybe Ben can explain some of that. I don't want to steal his thunder. But it was a very smooth process. It was very easy. They gave me great loan to value options. I felt like the rates were competitive for a DSCR loan. And so I was very happy. So Ben, I'm gonna kind of open it up to you. What specifics about this product does the general public need to know, and why is it so unique?
So when people think home equity line of credit, they think of their house, typically, right?
For sure.
And it's never in history, there's never really been a line of credit option for a rental property, especially an Airbnb, and especially if it's held in an LLC or an entity, right? And so recently, we've saw this just at a high level that this was, I think, a huge thing that was lacking amongst investors. And so I was able to spearhead and be one of the beta testers for this product. And so we've launched it since then. And it's really grown to be what it is now and what you tried, Stan, when you did it. And I think what people need to know is that a line of credit on your rental property without showing tax returns and traditional income, even if you write off all your income, if you show no money on paper and you just have rents, right, coming in, these lines of credit were developed for you, right? They're developed to help you. And I think lines of credit are so powerful right now versus just taking cash out. And I'll explain, I can get into why I think right now there's just so much demand for this because, and if I'm rambling too much, tell me, but
no, you're fine.
We have, since COVID, what happened was everybody refinanced their mortgages and they were between 2 to 3%, right? And so what happened after COVID was values started to go up, of course, right? If you bought in 2018, 2019, you kind of got lucky, right? Because you bought before the increase. And so everybody's values went up. We have a ton of equity right now, which is also why I think the market won't crash because our loan to values are actually not as high as they were in 2008.
Yeah, there's no foreclosures.
Yeah, and foreclosures as well. And we're not highly, we're not over leveraged anyway. But what's really effective about this is that all these guys built up equity, right? Or they bought properties and now they quit their jobs or they don't have traditional income or they just don't fit the box that the banks want them to be in for a traditional line of credit. Not only that, but like the product virtually doesn't exist for investment properties. They were actually built, by the way, for farmers. That's actually how they were developed. for primary like owner occupied homes. That's how they started, right? That's number one. Okay. Number two, loan officers don't make a lot of money on these HELOCs. Okay. I'm going to say it again. Loan officers do not make a lot of money on these HELOCs. There's a reason why they're not marketing it. They're not talking about it, right? Because they get paid like $100 to fund the deal, right? It could be a $1 million HELOC. It like almost doesn't matter. So because they don't get paid as much, right? They don't talk about it. And so and that's how I was trained. When I got trained and I got my license, Stan, and before really HELOCs came onto the scene, they were still kind of around, but we were always trained to like talk down to lines of credit and always push the cash out refinance because that's how we got paid, right? It's like, oh, forget it, pay off the first mortgage. Let's just do a regular cash out loan. And for the listeners here and for Stan, as you know, the problem with that is if you have a low rate on the mortgage that you don't want to lose, and also you don't want all the money coming to you, and then after you spend it, you can't use it again. What do? You're kind of stuck.
Yeah.
And that's why lines of credit are so effective. I know I'm kind of giving you a long answer, but
that was a great answer. Well, and I'll just chime in that, for those that aren't as experienced, and that are maybe like trying to comprehend all this, I've actually discovered that cash out refi can sometimes be a foreign concept to some people. Some people don't know that exists. So, let's say that you owe $200,000 on a property worth $500,000, you could refi that and basically, probably get a loan for up to $400,000, and that would basically then you'd get paid roughly $200,000. There, it wouldn't quite be that, but you would get paid basically the difference between the loan that's being paid off and the amount that you're getting for the next loan. And so you go to closing, you receive money at closing, which is great, but you just redid all your terms. So if you had a 2% rate, you just refinanced at 6%. Your rate just tripled, and your mortgage payment more than tripled, most likely, because you're also having a higher principal. So a home equity line of credit, you keep your loan that you already have on the property, 2, 3, 4, whatever percent, and now you just have a second loan on top of that that you can use.
And what nobody's talking about right now is that when it comes to refinancing, there's 3 reasons people refinance. Either you lower the rate, you shorten the term, or you take cash out. When people hear refinance, they think it means one thing or the other. They hear refinance, they think, oh, it's me taking equity out, or it's me paying down getting a lower rate. It's like, no, there's actually different types of refinances, right? And believe it or not, a HELOC is actually considered it's actually a refinance technically, like in our world, right? Now to the consumers, I don't say that because it just confuses people. But those are the 3 reasons. And so you hit the nail on the head. Cash out refinancing, we do it a lot, especially with DSCR loans, which I can break down in a second. But cash out refinancing is extremely effective, especially with the BRRRR method. But it's just nice to have a second option if you don't want to pay off the loan. Instead, you want to have a loan come behind it as a second lien that keeps the first mortgage intact. And so we're doing that a lot right now for investors. I think if for anyone listening, if you guys want to implement the BRRRR method, we're using this a lot as well for properties that you, let's say, buy, you do value adds, rehabs, right? And you add a bedrooms, bathroom, you adjust the floor plan, whatever the value add was done. When you do that to a property and now you're ready to take cash out, what's really great about HELOCs is you only need 3 months seasoning, right? So you need to own the property for 3 months to then take the HELOC on it for this product. I have another one that can do it faster, but it just depends. But in general, 3 months is the rule. And so with that, you can use a line of credit to take equity out, pay off the hard money lender if you need to. The only downside is it doesn't pick up on the new value sometimes. So you have to be wary of that. But in general, it's great because you can use the HELOC money. Even, I'm kind of rambling here, but even on a primary residence, so a lot of guys, what they're doing now is they have equity built up in the primary that they refinanced during COVID, right? Like most people. And they want to start doing the BRRRR method, or they want to start investing in real estate, right? Like if that's you, whoever's listening to this, like try this strategy. You can go up to 85% loan to value. So like, let's say you have a house that's paid off. Let's say it's $100K for simple math. It's worth $100K. You can get up to $85,000 on your primary residence as a line of credit. And you can take that money and actually use it as a down payment for another rental or an Airbnb or a BRRRR, right? Whatever the case might be. And so it's really effective to use it to start investing once you have capital. Yeah.
And for those kind of unfamiliar with the Burr method, we've talked about it on the show, but buy,
Yep.
rehab, refinance, rent, or you
Hmm.
might put the rent before the refinance, depending on, but
Yeah.
roughly that's a strategy that a lot of investors use if they're okay with debt. Some investors are anti-debt, which I respect. But if you're not, this is the way that's a method that a lot of investors will use. Make a cash purchase and then make the cash rehab or maybe a hard money, and then rent it out and then eventually refinance after the
Yep.
rehab's complete.
Yeah,
Now,
where that's like the closest thing to no money down. Like I hate saying that because there's no
mhm,
such thing as no money down unless you're raising money and unless, whatever,
sure.
it's seller financing. But there is kind of that hack, I guess if you want to call it, where you leverage a HELOC, you leverage your equity and you use that as a down payment and then use the hard money lender to fund the rest, right? The rest of the 80% or whatever, and you fund that 20% down payment. And then that's how it's like, yeah, now you're buying properties without spending a dime of your own money,
Yeah,
right? It can
absolutely.
happen that way, but you're just leveraging two assets at the same time. Yeah.
For sure. So, what about like multi-unit properties?
Yeah, so this works. So this HELOC program is up to 4 units. I have a lot of people that ask about commercial lines of credit, like
Mhm.
five to 10 unit buildings, 20 unit buildings. I don't have anything right now on the market that exists for that. We're trying. It's just really hard because it's commercial. But up to 4 unit properties, you guys got a duplex, triplex, quadplex. You can actually use this line of credit. Yeah.
It's got to be, yeah, but it's got to be all those units have to be in the same structure.
Like yes, yeah, correct. Yeah.
Because, yeah, otherwise it would be a commercial, functionally a commercial property.
Yeah.
So, if I could ask you a personal question, because you alluded
Mhm.
to that these aren't big money makers. So, what is the incentive for you to go on a show like this and advertise this?
So I believe in helping people, especially investors, because my heart goes out to investors. I want to help you guys for the sake of helping you, not just pursuing a paycheck, which I've hoped, Stan, when you got the HELOC, that's the sense you got from us and working with this product,
Hmm.
is that like we genuinely care. Now, of course, I still get paid. I still get paid a percentage. But yeah, it's not a lot. My hope is long term to develop a relationship where when the investor is ready to use this money to whether it be hard to get hard money financing because we do that or DSCR loans where you could purchase a rental property with no income verification or debt verification at all. DSCR basically just lets you buy a rental as long as the rental income covers the property, you're good to go. So it's a really simple loan for investors. And so limited financing. As long as you have 20% down, guys, you could buy as many as you want. So that's what I mean by DSCR. And so if the long-term plan is, hey, let's give you the money, you go spend it, and then we work together on buying the next rental, the next flip, or whatever the case might be, right? That's the hope
That makes
long
sense.
term. I don't
Yeah.
want to just be a one and done. Like I have a lot of investors now. I already have their information. They're just like, Ben, hey, here's a property we found. Here and here's my statement. And then we go. That's it. Like we don't need to talk for an hour. You don't need to send me a bunch of docs. It's like I already have your information. I
So, are
just duplicate
you
the file and we just start.
do you include does that include the rehab costs and all of that, or is that just the property purchase?
Yeah, so for my flippers, it's just, hey, send me the scope of work. Who's the GC you're using? Is it the same guy? Okay, great. Send me the scope of work. What's the purchase price? Give me the contract, right? Like those are the basics. I already have credit score application. Same thing for DSCR. If you're ready to buy a rental property, hey, I just need to see updated. I need to see updated statements, right? So bank statements. Where's the money coming from? I already have your credit report. If we need to get a new credit report, no problem. But it's so seamless now because investors are really busy. Like you guys are busy. We're busy. We're constantly running around. We're getting a million spam calls, a million emails. Like there's just too much going on in
Yeah,
this noisy world. And
that's
so
for
I think it
sure.
helps to have someone in your corner that's just like, I already have all your information. You just got to give me the address and then we just go. And then
Sure.
you're like, hey, send me the numbers. I want to do 20% down compared to 25% down. What's the rate? Okay, cool. If I do a 3-year prepayment penalty instead of a 5, let's compare that. Okay, great. I want this one. And then we go. So it's
Sure.
really, it's a seamless and effective way of doing real estate. Yeah.
And if it sounds too good to be true, I actually, when you first described it to me, I was like,
There's no
this
way.
this sounds too good to be true. And I mean, until I got the money, I continued to have that mindset because I've been overpromised by
Yeah.
investor friendly lenders before. You did not overpromise, so I'll just share real quick my experience with the audience. So, I mean, basically, you were just like, hey, go to this link, and it's going to ask you for your address. It's going to pull your credit, and it's gonna look at your income through the Plaid third party verification app. And I did that. It took 10, 15, 20 minutes, something like that. And it immediately like spit out like basically a valuation that was great. Not had no issues with the valuation. It spit out income numbers that were great via Plaid. I'm not exactly sure how all that works because it did not match what my tax return said, but it was better because I'm self-employed. I get that number as low as possible, so I was very
Yep.
happy that I
Yep.
wasn't looking at my tax returns. And then it was just a matter of just waiting for underwriting. No appraisal,
Yep.
no inspections, no photos. I mean, it was like I didn't have to
Yep.
provide uh, any of my anything from Airbnb. I didn't have to provide anything from my property manager. My property manager doesn't even know what happened. Um, so kind of amazing. I mean, it takes a lot to amaze me in real estate. I've been investing for close to 15 years, been a realtor for 10 years, and that amazed me. I'm not gonna lie.
Yeah. And I appreciate that. Like that is amongst many of the feedback that we've got, Stan. And that's the whole reason why it was built that way, where it's just so easy. You're not bothering your tenants. You're not freaking them out because an appraiser now has to visit
Yep.
their units, right? Or their unit if you do have, if it's a single family or whatever. And if it's an Airbnb, it's vacant, if, at the time, depending on the guest bookings. But you get the point. Like it's just so easy. I've never in my entire career, I've been doing this for 6 years now. And it's like, yeah, I look like I'm 15 on camera. So it's like,
You
I'm
gotta
not
do
going to
what
say
I
I've been
did
doing this
because
for
people
20.
told me that, and so I had to grow
Oh,
out
yeah.
facial hair.
I actually can't stand facial hair. So I don't know. We'll see about that. But the thing is, in my career, I've never seen an easier way in my entire life to take out money on a
Hmm.
property. We have some investors stand now because the rule is with this HELOC, you have to wait every 45 days to use it again on any property that you want. And so I have investors that have done it already a couple times. They know the system so well. They already know what it's going to ask because it's the same exact way every time.
Hmm.
Now, if your property's in a trust or if you have a different LLC, it's like, yeah, okay, slightly different documentation. Or
Sure.
if you have something against you on title, a judgment, yeah, like, okay, that changes things. But for the most part, it's the same. And so I had these guys look at their money like within 6 7 days. Like that's how fast it just moves now because they just know the process. And so,
Yep.
yeah, I'm glad to hear that you had such a good experience because I think there's so many investors. I cannot tell you, Stan, how many guys call me and they're like, I wish I knew about this sooner and before
Yeah.
I did all these other
Absolutely.
deals. Yeah.
What kind of rates? And I know nobody lenders don't like me to ask questions like this, but it's a question that people listening
Okay.
are going to have.
Yeah.
So if you don't want to answer, that's fine, or if you feel like you can't. But like, what kind of rates are you
Yeah.
seeing for any of these loan programs? Pick one that you feel like is a safe one to
Yeah.
discuss.
I'll give a range, guys. And at the time of this recording, of course, we're in the month of June,
Okay.
so of 2026.
Yeah,
So
this is
obviously,
probably
like
not going to air until
things could
July,
change.
so things might change.
Okay. So yeah, who knows? But I still want to help the best way that I can. Before I even answer that too, one thing to preface, guys, is that remember it's a line of credit. It's not a 30-year fixed mortgage. So a lot of people sometimes expect HELOC rates to be the same as 30-year fixed mortgages, and they're actually not. It's apples and oranges.
Yeah.
Remember, these lenders only make money on the interest and on the balance you have active, right? It's like a credit card. If you don't carry a balance month to month, you don't pay interest month to month, right? A HELOC is kind of similar, right? If you don't have a balance, then guess what? You're not paying interest, right? There's no active payments every single month. And so keep that in mind too. But for these rates, they're anywhere from 7% to, I want to say, 11% right now, depending on investment property, credit score, is it an LLC? Like, what's your situation, right? So the algorithm puts all the data together, which, by the way, guys, you can check via a soft check actually in the beginning. You don't even have to pull credit. You can literally just kind of window shop and just see, hey, I got a couple
Hmm.
rentals. What is the system going to offer me, right? And it'll tell you, right? It'll tell you, hey, I'll give you 100K for this property, or hey, I'll give you 300K, right? We just had a guy that closed a $500,000 HELOC. He was ecstatic. But the point that I'm making is that the rates are anywhere from 7 to 11%. Actually, Stan, after you just closed your HELOC, we just rolled out variable options. So the rates are typically fixed. Guys, just so you know, because this confuses a lot of people, just because it's a fixed rate doesn't mean it's not a line of credit. You can have a line of credit and still be a fixed rate. It's sort of a hybrid model that we've built. So it's a hybrid where it's still a line of credit. You draw and pay back as you go, and the rates are fixed, so they're flat, so they don't change month to month. There's no ceiling, there's no floor. We just rolled out, though, a variable option. If you do want variable rates that adjust with the market, you can select that as well. But of course, it's subject to change month to month. And then one more important thing, too, is you have a 4-month draw period usually with these. So 4 years, you can draw on the money, guys, as many times as you want. There's no draw fees. And then after those 4 years, the payments just resume like normal, or you just make payments like normal, like a normal HELOC, or I'm sorry, normal mortgage. And you can select the term, 20 years, 30 years.
What is the reason for that 4-year draw period? I'm curious about the logic behind that.
I think a lot of HELOCs in the past sometimes would be like 10 years. Like they'd be pretty long for a draw period, and they were pretty aggressive. And but the problem was that the process of getting them was longer. So what we did was we kind of built it to where it's easier to get, but the draw period is shorter, if that makes sense. The good news is you could pay it off with another HELOC, right? Like you could replace it if you want and start another HELOC for 4 years, right? It doesn't matter. But that's for our main HELOC product, the one that you use, Stan. That's just what they established it at, and that's what it's been since day one. So I don't know if they'll change it or adjust it, but yeah.
Now, when you said that you can't do commercial properties, how does the system, with it being so automated, how does it detect if a property is commercial or not?
Yeah, so we have some third-party vendors that we're synced up with. And so I don't want to get too technical because it's going to get confusing.
Yeah, sure.
APIs and
just high level. I was just curious.
Yeah, we have through an automated valuation model, the AVM, which is just like this fancy tech that was developed to help establish the values of the properties, the bedrooms and bathrooms, the square footage, the rental valuations, right? And then amongst that, it also tries to look at zoning, where it's like, hey, what's the property zoned as? Now, is it perfect? No. We had one time a single family home. We had a duplex, but it came up as a single family home. And then we actually needed, but here's the thing, the system is smart enough to know like, hey, we're not confident in this value. So sometimes that'll happen. With you, I don't think it happened where we need to get a drive-by appraisal, but sometimes we need to get an appraisal, but it's a quick, like we call it drive-by appraisal, where they're not coming into the property, right? And so the reason for that is when the system is like, hey, we're not so confident on this score or on this property or on this value, I should say, we need someone to go in and just boots on the ground, really quick check. And so sometimes the system will default to that option as well. But yeah, it'll try its best to look at what is it like zoned at per like parcel number. Yeah.
Gotcha. Okay, that makes sense. I didn't know if people could maybe get sneaky. Maybe they got a property that that is kind of ambiguous.
I mean, you could try. Like, it doesn't hurt. I always tell people, I'm like, hey, try it. Like if you got a 4 unit, but it's got like 2 illegal units, so it's technically like a 6.
Right.
Like, hey, if it's legally zoned and it's set up as a 4, it's a 4, right? Like the system doesn't know it's a 6 or that you rent it out as a 6, right? Now, if we do a regular refinance or a DSCR loan where the appraiser comes in and he's got to go through all the units, now we're going to have problems.
Yeah. You're not fooling on appraiser.
Yeah, right. But with this one, it's kind of nice because it's like, hey, actually, try it. It's not going to pull your credit 5 times. It's just, hey, soft check. Does it work? And then you'll get a yes or no right away. That's why I love this so much, because it's so, I'll say the downside to it is that you can't fight the system. It's kind of like gospel, whatever it says, that's what it is. You can't like disagree or agree. Doesn't matter. If it thinks your property's worth 100K, but you think it's worth 400, I'm sorry.
It's not like AI that'll come back and say, oh, yes, you're right. Actually,
Oh, yeah. No. We use a lot of AI components to it. But yeah, that is one of the things that it's important to mention, guys. Like if you disagree with it, we'll have to use a different HELOC product. This one that Stan used and one we're talking about is not built for that. It's kind of automated. However, the beauty of it is if it gives us money and it tells us it's worth more than we thought or whatever, then that's it. That's what it is. And you get to go and fund and get your money, right? So yeah, it's cool for that too.
Yeah, fantastic.
Yeah.
Few other quick questions here, and then I'll let you go because I know you're a busy person.
No.
I mean, if you reach out to my podcast, I'm sure you're reaching out to a lot of podcasts, and you should because it's such a unique product that you're
Yeah,
offering.
we really want to get the word out. Yeah.
So
Yeah.
as far as like, let's talk about hard money real quick.
Yep.
Um, so what what sort of loan to values are you doing for that in terms of like
Yep.
rehabs? Are you doing 100% on the rehab? Explain all that real quick.
Yeah. So they're always, for anyone that doesn't know, hard money is just basically quick funds that we give you to buy a property and then also to rehab it. Right. So it sounds kind of bad, but it's not really like, it's not that, it's not like a whatever shark loan. What do they call it?
Oh yeah, yeah,
Anyway,
yeah, yeah.
um,
Shark lending kind of thing.
yeah, it's like okay, but the point to answer your question, so hard money lending, we have across the board 100% rehab for all the products, right? So we will fully fund your construction project as long as, of course, it makes sense. You're not spending, I don't know, 100K on paint, right? So they
Sure.
do look at that. But the way it works is we've just now released for this year 100% financing for both purchase and rehab, which is
Wow.
absolutely insane. The caveat to that is you have to have at least 30 deals in your entire lifetime experience, either rehabbing, developing, and holding or flipping. If I can show the underwriters an Excel sheet of 30 addresses that you've bought and that you've rehabbed, right? Even if you haven't sold them, you can get 100% financing. You just pay closing cost.
Would would
That's
uh
it.
would a duplex count as one or two for
A
the purposes of
duplex
that?
would count as one. It would
Okay.
count as one. Yeah. So it's one per property per parcel, right?
Okay.
So this program is great for the experienced investors. Guys, if you're not experienced, you're kind of new, the down payment is all based on your experience and credit score, I would want to say. But the max usually is 20% down loan to cost. So if I'm buying $100,000 house and my rehab budget is 150 is 50, so 150,000 is my loan to cost. So 20% down is 30K plus closing costs, right? So for those listening, starts at 20%. We'll fully fund the rehab, and then you can go as low as 5% down or even zero if you have extensive experience. It works in brackets, Stan. So if you're
Hmm.
like, if you've done 5 flips in your lifetime, then your down payment might go down to like 15%, right? Or maybe
Mm-hmm.
10. If you've done 15 flips, then yeah, you can probably go down to like 5 or 10% down. So you get the point. Like the more you do, the less you
Sure.
put down because we see your experience and you do this often. So yeah.
Yeah, absolutely. What about real quick on the hold side, the DSCR
Yep.
or non DSCR, hold
Yeah.
property side? What is there anything unique that you're doing besides the ease of the process
Yeah.
with regard to that?
What's great is because I'm kind of a one-stop shop, Stan. Like I don't want to toot my own horn and like be egotistical, but I really think
Well, you're on here
it's
for a
great that
reason.
yeah, I guess. What's great is we because I have multiple stages and products that like satisfy each stage. Like it's just one stop. Hey, we help you start to finish, right? And we'll give discounts, of course, because you're going to the same guy for multiple things. But what we'll do is hard money guys. Just because you're using money to rehab doesn't mean you have to sell. We speak in terms of fix and flipping, and hard money loans generally are 12-month loans, so they are short term. But you can pay off the loan, pay off that hard money lender, and do a cash out refinance with a DSCR loan to pay off that loan, and then have a tenant in there. So let me back up. So what I mean is, let's say you buy a single family house, guys, you put 20% down or whatever. We give you money to do construction. You complete construction. You're all done. You're ready to rent. So you have two exit strategies, guys. Either you rent out the property and you refinance it, or you sell it, right? So those are the two ways you can get your
Yep.
money. Problem with selling, of course, you get capital gains tax and all these other things unless you do a 1031. If you don't want to sell, you can then just do a DSCR refinance. DSCR does not look at personal income, no tax returns. It doesn't look at how much money you personally make. It looks at, what I love about it is even if the property is vacant, you can still use a DSCR loan. You don't have to have it rented out. Now that's preferred, but if the property is vacant, we can use market rents. And so with the DSCR loan, we'll come in, we'll do a 30-year fixed mortgage on it. That's what the DSCR is, 30-year fixed mortgage. If you have enough equity and the appraiser thinks it's valuable enough to where there's equity, then you can possibly take cash out and go on to the next deal, or at least pay off that 12-month loan that you got, because hard money loans are short term.
Yep,
So
absolutely.
those are the two primary exit strategies my investors are using, and we'll help with the hard money and we'll help with the DSCR. So it's really fast.
Absolutely. Well,
Yeah.
I think that's all the time that we have. That was all fantastic. For those listening, I will put Ben's information in the show notes. Ben, I'll connect with you after the show to make sure I put exactly the correct information in there.
Yeah.
Is there anything that you wanted to say that we didn't get to?
Nope. The last thing I would just say, Stan, is guys, there's a lot to cover and everyone's situation is different. So the best way is just at the time of this recording, I have it open to the public. I don't know for how much longer, but you can book a call directly with me on my calendar, or you guys can shoot me an email. And so my YouTube channel is Funding Freedom, or my website is fundingfreedom.net. So if you guys look me up, my information's on there. You can go ahead and apply or reach out, email, book a call, whatever the case might be, and we can help you out. Yeah.
Absolutely. Well, Ben, thank you so much. That was Ben Stef with Funding Freedom. Thank you all for listening or watching. My contact information, Ben's contact information is in the show notes. If you like this content, please like, rate, review, subscribe. And I'll talk to you guys again next time.